US stocks versus international stocks. S&P 500 index versus the MSCI All Country World Index excluding USA. Let's compare the two. From 1970 through 2021, 11.1% versus 9.4%. Since 1980 through 2021 again, 12.3% versus 9%. Since 1990, since 2000, since 2010. So, why would anyone want any international exposure? It's a good question. I've been asking myself the same thing. Here is some of what I found. First, I think you can have a successful investment experience without any international exposure. The data just shared already provides evidence to this point. Also, Jack Bogle and Warren Buffett said it, article linked, so that's not nothing. Those two data points alone are enough to convince many surface dwellers. But I wanted to dive a little deeper for you and for me to see if there was anything more below the surface. From 1970 through 2021, in 24 of those calendar years, international stocks outperformed US stocks. That is roughly 46% of the time out of the 52 years I looked at. Nearly a coin flip at the beginning of each calendar year. Which will do better? The US versus international or international versus US premium tends to come in bunches. 1971 to 1976, US stocks did 3.2%, while international stocks did 12.6%. 1980 to 1988, international stocks outperformed in 6 of the 9 calendar years, outperforming US stocks by 6% over this time period. From 1989 to 1998, US stocks outperformed in 8 of the 10 calendar years, outperforming international stocks by over 10%. 1999 to 2009, international stocks outperformed US stocks in 8 of the 11 calendar years. And from 2010 to 2021, US stocks outperformed international stocks in 10 of the 12 years. So, despite the international underperformance, especially recently, that's not always the case. Am I recommending you jump back and forth during these periods of outperformance on either side? No, I'm not. That would likely be tax inefficient, time consuming, and well, impossible. At least impossible to predict consistently. I think this information makes a good case for diversification, especially long term. US stocks have dominated recently. Will this continue? I don't know. But consider the following. A publicly traded company's share price is often anchored to the earnings of that company. More loosely in the short term, more firmly in the long term. When a person says this company is way overvalued, they are usually trying to sound intelligent. Try it at your next dinner party. That company you're talking about is way overvalued. And then kind of look off in the distance and shake your head and quickly change the subject. I kid. Smart people who say this are usually referring to the share price of that company relative to the earnings of that company. The price is way more than the underlying earnings. This happens because of demand and momentum and investor expectations and the herd mentality, among others. In 1990, US stock valuations were half of international stock valuations. What the heck does that mean? Assume all US companies and all international companies had the same earnings that I was just talking about. People were paying double the share price to be an owner in international companies. At the end of 2022, US stock valuations were 1.5 times international stock valuations. US stock valuations tripled from 1990 to the end of 2022. Said differently, US stocks have become much more expensive the last 30 years. This means a lot of investors have been pouring into US stocks, causing share prices to rise and investors in US stock markets to be pleased. But it also means some of the outperformance in US stocks, especially recently, can be attributed to demand alone, not solely the earnings and success of the underlying companies in the US, despite there being many. Let's move on. DocuSign is a company most of us have interacted with. Their service allows you to sign documents electronically as opposed to in person. Guess what happened to their share price in 2020 during the heart of the COVID pandemic when seeing people in person was difficult, even outlawed? Well, it was up nearly 200%. People piled on, quickly jumping on board as more and more continued to do so. so. The share price skyrocketed despite company earnings and other metrics. What about 2021 when things normalized? Down 31%. And 2022, down 63%. What about those people who invested in DocuSign at the tail end of 2020 expecting the same thing moving into the future? It's been a rough time since, but not completely unexpected. Just a reversion to the mean. I'm not saying US stocks are like DocuSign. I'm also not trying to beat up on DocuSign. I'm trying to draw your attention to your own behavior, and mine. I'm guilty too. Don't avoid international stock exposure for the same reason people poured into DocuSign. Past performance is no indication of future results. Past performance is surface level analysis. My compliance approved takeaway after diving deep and finding some of the hidden sea treasures I found. To be clear, I never did any actual swimming or deep sea diving for the making of this video. I think you increase your chances of a better risk-adjusted return and investment experience with additional diversification in international markets, especially moving into the future. And you heard it here first, a deep sea diving metaphor in defense of some international diversification. Until next time. Until next time. And until the next time we see each other. I'll see you next time. Until next time. Until we meet again. Until we see each other again.